Sir, X Limited is there. It gave a loan to employee 1 lakh rupees at the rate of 2% per annum for 3 years. Market interest rate is 10% per annum. So 0, 1, 2, 3. Today we gave an amount of 1 lakh to our employee. Sir, when market interest rate is 10%, why did we give loan only at 2%? Why? Because he is my employee. If he is some roadside fellow, why will I give, sir? He is because my employee only, I gave it at 2%. So for the next 3 years, what cash flows will you receive? 2000 and 2000 and 1 lakh 2000. Correct? Now, tell me, sir, what is the entity's objective with this? Are we going to sell the loan and all? No. We are going to collect cash flows from the employee. Ideal method what you have to apply is ACM only. What is the entry you write to tell me when loan is given normally? Loan given, account debit to bank. What is the initial recognition principle under ACM? Initial recognition principle, ACM. Fair value adjusted with the transaction cost. For example, transaction costs are not there. So I have to record the loan receivable at fair value only. What is the fair value? This 1 lakh is the transaction value. Today I paid 1 lakh, but this is not the fair value. Sir, how will I know the fair value? Simple, sir. Take this employee, hold him, take to the bank. Tell the bank that, bank, I will pay you 2000 first year loan, 2000 second year loan, third year I will pay 1 lakh 2000. Today how much loan will you give me? I'm going to ask bank. Bank will expect how much return? 10%. Considering that, how much loan this fellow deserves for the cash flows what he is paying us, calculate that. That is the fair value. Always a loan ki, bond ki, fair value is nothing but present value of future cash flows discounted at market interest rate. That is fair value. So what you do is, e-cash flows discounted to today. 2000 into PV IFA annuity factor 10% 3 periods. 1 lakh rupees only once I am receiving, so I will apply a PV factor 10% third period. So if you work out this, how much did you get my 80? 80105. 80105. Ideally, for the cash inflows what the employee is paying to the company, our company should give him only an amount of 80,105. But looking at his face, because he is our employee, I paid him 1 lakh. How much extra did I pay? 19,895. The extra amount paid. Now, what is the accounting for this? Accounting is very simple, sir. Look at this. Staff loan account debit. Fair value, I should record in ACM. To bank. What I am paying is 1 lakh. E gap whatever is coming, 19,895, which is a balancing figure here, which is basically a kind of benefit what the company has given to the employee. E accounting, sir, it depends now. Definitely, very clearly, company has given freely an amount of 19,895 to the employee. The employee cost, it has to come to P&L account basically. But when will it come? Because loan period is how many years? 3 years. Generally, sir, generally, when I give a loan to you for a period of 3 years, what is the prima facie condition I put? For the next 3 years, you should be in our employment only. Correct? No, it's not like today I give loan to you, tomorrow morning you resign and join some other company and I keep on collecting like a stupid 2,000 rupees from you. Will it be that case? No. Generally, when a concessional interest rate loan is given to the employee, usually this condition will be there that employee should continue to work for our office in the next 3 years also. That means, money is not freely given. Money is the cost what you are paying to the employee to retain him in the company for another 3 years. So next 3 years he will stay here, give you services. For that you are paying today 19,895. Benefit is going to come in the next 3 years. Therefore, we usually debit this to a prepaid expense, which we call it as prepaid staff cost. If the question tells you that, which generally it won't, but in case the question tells you that, sir, there is no condition like that to the employee. We have given loan to him, concession interest rate loan, based on the services what he already gave us in the past. I don't expect him to continue his service. If he stays, that's okay. Even if he does not stay also, we don't mind, we'll still give loan. In that case, you are not expecting any benefit from the employee in future. Sir, why sir? Benefits already received in the past. So in that case, this has to be thrown off to PRL right now. In that case, I will use the word staff cost. This is debited to PRL immediately. You have to watch the question, sir, and then accordingly decide. For this case, this is amortized to PRL over loan period in straight line method. Which one will you do depends on question ka data. And since I have seen all the questions that are there in your study mat RTP exam till now, either they will tell you that there is a condition or the question is silent. Just because question is silent, don't assume this. Always assume this only. All the answers given in your ICS study material are only prepaid staff cost cases. You also assume like that even if the question is silent. But staff cost, entire amount throwing it off to PRL on a case is possible, sir. INDAS 109, it's very clearly there. Once upon a time, CA Institute exams also it has asked, but that's not under INDAS ka zamana. So that's why examples I did not keep. Whatever today in this curriculum, prepaid staff cost is what you will do if the question is silent. When you will amortize it off to P&L account every year, it won't be there. 3 years lo amortize chestam. Sir, prepaid staff cost ane daniki logic endante, sir, you are giving a benefit to the employee, and for the benefit what you have given to the employee, you put some conditions. Generally the condition is make him work for some more period. So for working that extra period, you are giving an extra benefit to him. So 19,895 should be amortized over such period basically. So that's the general logic there. Sir, hereafter what will happen? Hereafter, on this you will go and apply ACM. ACM application means what? Initial recognition already over. Hereafter, every year interest income you have to record according to EIR, and whatever cash flows is given, record that. Like that, if you go on recording for a period of 3 years, your loan account automatically will become 0. A staff cost is directly PRL, prepaid staff cost you will amortize it to PRL over a period of 3 years in this example. Like this it works. This is the basic version of staff loan. In this only one adjustment is there. That adjustment I will directly show you while doing the question. We will directly take up the biggest question we have on staff loan. There are other questions also, they are solved, they are cheap, sir, they are less dangerous. Biggest question what we have that we will take and we will solve that. In that only one good adjustment is also there. What is the page number of instrument, sir? 13 point? Okay. Go to question number 150, 120, 150, 120, 130, arrange somewhere. It still is 84. Sir, once instruments is over, I'll give you a list of questions which are the bare minimum questions you have to prepare. Worst scenario. Okay, ideally I will never give important. Now also I'm not giving important because there are 150 plus questions. Sometimes one panic kind of situation can arise. So 20 questions or something like that I'll give you. Worst case la 20 questions if you prepare and go also, you are safe for the exam. Concept completely, questions practice 20, that's enough. That is, once we cover everything then I will tell you. But ideally you should prepare everything. Embedded derivative, not it, not it, not you, not you, not you, not you, not you also. Coming. Question number 120, yeah. Oh, yeah. You. Question number 155, please. Read. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Mr. X, who is executive assistant to the CEO of Wheel Company Limited, took a loan from the company on the following terms. Principal amount 10 lakhs, interest rate 4% for the first 4 lakhs and 7% for the next 6 lakhs. See this fellow's sadism. Out of 10 lakh rupees, he is breaking the principal into two principals. One 4 lakh principal, one 6 lakh principal. If 4 lakh, you will have to apply 4% interest, and on this you have to apply 7% interest. Starting date is given 1st Jan 20x1. Life is 5 years. Prepayment can be done anytime at the option of the employee. The principal amount of the loan shall be recovered in 5 equal annual installments. Underline this word. Principal is recovered in 5 equal annual installments. That means your principal amount is 2 lakhs per annum. When the employee pays 2 lakhs, which principal is deemed to get over firstly, it seems, and will be first applied to 7% interest bearing principal. Our company gave loan to an employee 10 lakhs. E loan lo there are two principals, one 4 lakh principal, one 6 lakh principal. When the employee gives us first 2 lakhs, I will feel that he has paid me a portion of 6 lakhs. Thereafter another 2 lakhs, thereafter another 2 lakhs. This gets over. Last 2 installments are relating to this 4 lakhs principal. That's how you have to understand. The accrued interest also shall be paid on annual basis. So every year apart from 2 lakhs, extra also you have to pay interest. And then outrightly he is telling that you must remain in the service. So that gap whatever comes will be adjusted into prepaid staff cost. The market rate of a comparable loan available to Mr. X is 12% per annum. If Mr. X goes to the market, he can raise money only at the rate of 12%. We are at least giving it 4 and 7%. The following table shows the contractually expected cash flows from the loan given to Mr. X. You need not even work out the loan cash flows. That fellow only has given. Today, 10 lakhs you gave. Every year that boy will pay 2 lakhs principal. First year interest also has to pay. All of you take your calculator, work out and measure the math. Sir, first year 2 lakhs, when did he pay us? End of first year. That throughout the year, how much is outstanding? Entire 10 lakhs is outstanding. On the 10 lakhs, how much interest we have to pay? 4 lakhs means 4%. 6 lakhs means 7%. 6 lakhs means 7% is 42,000. 4 lakhs ka 4% is 16,000. 42 plus 16, 58,000. So 42, 60. First year ending, he pays off one principal component of 2 lakhs. So hereafter your remaining principal outstanding is 8 lakhs. In this 8 lakhs, our original 4 lakhs at 4% is anyway there. Our 6 lakhs now became 4 lakhs. On that interest has to be computed at the rate of 7%. So next year interest is how much? 4 lakhs into 7%, 28,000. Plus the remaining 4 lakhs into 4%, 16,000. So 28 plus 16, 42,000. All that you need not do, that fellow has given. You should just understand how they have computed, that's enough. Like that, for next 5 years if you pay, happily the loan amount will be over. Mr. S prepays the loan, something is telling. Let's do one thing. A prepayment and all happened at the second year. So first what happened or what is to be done on the very first day, let's try to work out that. Come to your notes, sir. Question number 155. So first and foremost, you have to work out the fair valuation of the loan receivable. Why should I work out the fair value? In ACM, initial recognition is at fair value plus transaction cost. So I definitely need fair value. Normally bond key, share key, fair value ante market value. But this is not a bond. This is not a equity share. What is this? Loan given. Loan given is traded in the market. Stock market, like, can I go and bring the value of this? No. So loan receivables ki, loan payables ki fair value is nothing but present value of future cash flows discounted at interest rate. You go to the market and bring. Okay, so just as a principle, if you want, you can write this present value of future cash flows at market rate or market interest rate. Let it be loan receivable, loan payable. Ide technique. So here cash flows, PV factor or discounting factor is given at what rate? 12%. And present value of cash flows or discounted cash flows. First year, already they gave, sir, you just total it up. 2,58,000 first year. Second year 2,42,000. Sorry, 44. Right. 230, yeah. 216 and 2,11,000. In the next 5 years ka loan cash flows, installments including interest. PV factors. You can see normally if the question gives you any PV factors, use that only. Why questions give PV factors is not because you don't know. They want a uniform answer for everybody. Correction will be easy for them. For that purpose they'll give you. And sometimes when you use that PV factors only, round numbers will come. Okay, so when question gives you PV factors, use that. If question does not give, so you compute your own PV factors. Generally 4 digits is best. 711,863,55,56. Do this math. Tell me this total. 8 lakh 40. 88. 6, okay. This is present value and this is also the fair value of staff loan. This is what ideally you should give, but what you gave is 10 lakhs. You extra gave some amount that will go into prepaid staff cost account. If this number does not match with whatever they have printed in the solution, that's because of PV factors. That's okay, sir. That is not to be worried. Sir, till here I don't think you have a doubt. Okay, now the entry what you should pass on the very first day is 1st January 20x1. Staff loan only at fair value, which is 843,886. Since we are asking him to stay in the company, definitely this gap must be transferred to prepaid staff cost to bank. How much am I paying? 10 lakhs to that fellow. So work out this, 151, 156, 114. It's already solved solution, sir. If you don't write also, it's okay. If you write also, it's fantastic. Now, hereafter, sir, on this staff loan, all you have to do is just apply ACM. It is straight line method, just amortize it to P&L account. Like that you have to do for how many years? Next to 5 years. Katama loan account will become 0. But this fellow gave a twist that somewhere after 2 years, he did one extra payment, prepayment he did. What is to be done at the time of prepayment, we will see when we go there. So first let's do accounting for how many years? It was 2 years. Because prepayment happened at the end of second year. Up to second year normally you do. Prepayment how to do we will see at that time. It's a very cheap adjustment, sir. I can tell you now also how to do, but I don't want you to think also because it's that cheap. So that much patience we don't have. Right. If you are writing. Exam lo don't do this model, you will unnecessarily lose marks. I'm warning you before only. Only exam lo you only told and you should not ask me. At the end of each, what is the balance sheet date here? December, huh? Okay. 31st December x1, 31st December x2, 31st December x3, 31st December x4. Ideally, the smart version, sir, exam lo, if I am the valuer, you do this, I'll give 1 mark extra also for doing this. But he'll say, you are not writing imposition, sir. Asal real life you will not write entry. A system will write. The labor work, no, sir, they are expecting you to write every year 4 entries like that for 4 years means 16 entries you have to write. Extra modification or some modification is there here. For that 1 or 2 entries extra. Hands will pain, sir. Okay, anyway, let's first focus. Every year, what accounting we have to do? Under ECM, you have to recognize interest income. You have to receive contractual cash flows. Sir, nothing else. Now look at this. What is the entry for interest income? Bank to interest. Those days are over. In our life, those days are over. Bank to interest and a day is over. What is the entry? Financial asset account debit to interest income. So the entry what you should write is staff loan account debit to interest income. Sir, how much is first year interest income? Adi cut brackets lo somewhere will calculate, not a problem. Okay, next. B point. Interest income will throw off into P&L account. Very good, sir. Staff who took loan from us, he will pay some amount. Contractual cash flow received. Bank to staff loan. Then, whatever staff prepaid staff cost and you wrote, that you will have to amortize it to PRL. So, this is amortization. What is the amount of prepaid staff cost you told me? 156,114 divided by 5 what answer? Please tell me the number. 31,223. Then D point is or simply balance in staff loan account. This is not entry, just a number. These 4 items if you record for each year, drama over. Tell me, sir, staff loan ke first year ke interest calculation you want. How to compute? On which amount? 843, 886 into 12%. How much did you get? 102, 101,266. Okay, nice. This went off to P&L account. The moment you credit interest income, this is the number that goes to PRL. Bank to staff loan. Our boy pays us in the first year 2,58,000. Amortization anyway we wrote off. Second year also same amount only. Don't disturb third year and fourth year. Later on we'll see. So staff loan ka balance at the end of first year. Why are we interested in that? If you don't know closing balance of financial asset of first year, second year on what amount will you calculate interest cost? Work out and tell me. 843, 886 opening balance plus 101,266 minus 258,000. 1, 2. On this 687,152, apply 12% to get second year ka interest income. 82,458. Second year our boy is giving us 2,44,000. Prepayment he did, don't even worry about that. Later on we'll see. 244. What's the balance now? After this normal payment. 600. 610. Okay. Now read the remaining question if you have copied this. Somebody is doing this. Read the remaining part of the question. Up to here, normal thing happened, sir. Now this fellow did some extra drama. A drama ka accounting you have to do. Let's see the question now. What did he say? Mr. S prepays 2 lakh rupees on 31st December 2002, which is second year ending. Second year ka installment he anyway paid. The extra prepayment, and therefore reducing the principal balance at the date to 4 lakhs. Normally 10 lakhs loan low first year, second year 2 lakhs. If you pay, outstanding principal should be 6 lakhs. But because of this prepayment of another 2 lakhs, effectively principal became only 4 lakhs. The following table shows the actual cash flows from the loan given to Mr. X considering the prepayment event on 31st December 2002. Now that prepayment happened, 5-year installment loan has now become a 4-year installment loan. First year, second year he paid. Second year prepayment he did. Remaining 4 lakhs is there that he will pay in third year and fourth year. Entire revised cash flows they are giving. First low you gave 10 lakhs. First year he gave 2 lakhs. Second year he gave you 4 lakhs. Third year lo another 2 lakhs he will give. Fourth year lo another 2 lakhs will give. And in the fifth year you don't have anything to receive. Your loan account gets closed at the end of fourth year itself. Even though loan was originally for a period of 5 years, because of a prepayment, loan has turned to be only 4 years loan. He asks you prepare journal entries for all the 5 years. So for first you should know how to do accounting for this prepayment. You will not write anything. Watch. If somebody is writing, you can copy at once. Second year, what is the carrying amount of your loan balance after writing normal installment 525.16? Each stage, what did this fellow do? Prepayment. So on 31st December 2000x2, prepayment received. You don't have a choice. You have to debit bank account. How much did he pay? 2 lakhs. Go credit this to your staff loan account normally as usual. 2 lakhs. After this, the carrying amount of staff loan account will be 3,25,016. Tell me, ma'am, this 2 lakh rupees extra whatever he paid now, is it within the plan or unexpected? Unexpected. That means your original estimated cash flow timings have changed. Original cash flow timing was what? First year 2 lakhs, second year 2 lakhs, third year, fourth year, fifth year, every year 2 lakhs. But now second year you are getting an amount of 4 lakhs. Because of that, your cash flow timings and series have got disturbed. Whenever cash flow payments and schedule gets disturbed, sir, ACM will not work. Why ACM will not work is, ACM closing balance should always represent the present value of future cash flows. The moment if you delay any payment or you pay anything early or you don't pay at all, then what will happen is cash flow schedule got disturbed. When cash flow schedule gets disturbed, ACM will fail. ACM will not work. For one moment if you hold, imagine that if prepayment is not there, then what is the carrying amount of your loan? If you want to patiently sit and work out, if 525.16 will represent the present value of 2 lakhs, 2 lakhs, 2 lakhs along with interest for the next 3 years discounted at the rate of 12%. Definitely it will match. 100% it will match. If that does not match, ACM will not work. Ultimately loan amount will not become 0 on the last day. But now what happened? 2 lakhs which are ideally supposed to receive after 1 year, that you are receiving today only, and this also gets preponed, this also gets preponed. Because of that your schedule of cash flow got disturbed. ACM will fail. Sir, then what to do, sir? What to do? Nothing. All you have to do is just to remeasure the loan. Remeasure the staff loan. In what way? To reflect the present value of future cash inflows. Discounted at what rate? Original EIR, sir. Original EIR. You should not go to the market today and bring today's rate. If you go to the market today and bring today's rate, that will become fair value. ACM fair valuation is not allowed. So original EIR only you should take. No fair valuations. Now, what are my remaining cash flows? My remaining cash flows are how many more years? 2 years. This you need not compute. That fellow has given to you nicely. One amount you have to receive on 31st December 20 x3. One amount you have to receive on 31st December 20 x4. But you are already standing at x2 ending. This is 1 year from today. Whereas this is 2 years from today. Why this has to be correctly identified is otherwise PV factors you will get it wrongly. You are already standing at the end of second year. Cash flows will come in third year and in fourth year. The third year and fourth year is 1 year away from you, 2 years away from you. Discounting also should be done only for 1 year and 2 years. Don't apply third year and fourth year PV factor. Should be careful. Okay, and regarding cash flows, question has given to you already. What will you receive? This, sorry. 2,16,000 and 2,08,000. Only this much you will receive. PV factors. First year PV factor 8929 7972. Total it up. 358. So my staff loan account load today how much balance is there? 325 is there, but 325,610 is not representing the present value of my revised future cash flows. Therefore, I have to restate the staff loan account from 325,610 to 358,673. I have to increase or decrease? Increase. So what is the entry I should write? Staff loan increase. Staff loan is an asset. Asset how to increase? By debiting it. So the entry should be what? Staff loan account debit. With how much amount, ma? 358,673 minus 325,610. 063. Now you should tell me where should I credit this? Where should I credit this? First of all, do you observe that increase in the value of the asset? Is it a gain for us? Staff loan is our asset only, no? Asset balance you are increasing. That is definitely a gain. Normally all gains should be going where? Normally every gain should go to P&L account only. But here the treatment is you should adjust this to your prepaid staff cost. Logic I will tell you. Prepaid staff cost we adjust. Are you having balance in prepaid staff cost? Yes, we have 1,50,000. First year, second year, even though you wrote off 31,000, still around 90,000 balance is there in that. So our 90,000 balance ki adjust of this 33,063. Sir, why should I adjust it to prepaid staff cost? Simple example, sir. Watch here. Suppose this boy, both are our employees only. I gave 1 lakh rupees loan to this fellow at 2%. Ade 1 lakh I also gave to him also at 2%. Market interest rate is 15%. So how much benefit is both these employees getting? 12% differential benefit they are getting. So both of them are getting same benefit, right? Imagine the loan what I gave him is for 3 years. The loan what I gave him is for 20 years. Who is getting more benefit? First boy, second boy? Second boy. Why? Technically speaking, 15% interest rate I am giving only for 2% or 3%. A difference is same for both of them. But the first fellow is taking a loan from me only for a period of 3 years. Second guy is taking for 15 years. The enjoyment of concession interest rate, he is doing it for more period. Isn't it, sir? The second employee is getting more benefit. Are you understanding this? Likewise, in particular case, sir, I gave loan, concession interest rate loan for how many years? 5 years. Thinking that I gave a loan for 5 years, the expenditure what I recorded is 1,56,114. But because of prepayment, what happened is the loan ka life ultimately is only 4 years. Mari, when I give loan of only 4 years, the benefit given to employee also is lower only. Therefore, my expense also should be lower. But this 156,114 is recorded with the intention that the loan is given for a period of 5 years. Employee enjoys the benefit for a period of 5 years. But actually loan turns out to be given it only for 4 years. So this much expenditure we should not have. But you already recorded that. So this you go and nullify that expenditure to that extent. That's the logic behind that. Had I recorded entire 156,114 on the first day directly into P&L account on that day, without calling it as a prepaid staff cost, in that case, this also will go to P&L account, right? So very, very obvious point, right? So this is the accounting, sir. If somebody is writing, you can write. The solution is there in ICS study mat also. Presentation, they'll obviously not do very greatly, but yeah. Sir, based on this workout, what is the remaining amount of prepaid staff cost balance? What is the prepaid staff cost ka balance? 156, 114 once upon a time. But first year, second year, you already have amortized something. So balance in prepaid staff cost. 156, 114 minus 31,223, 2 times I am doing, minus 33,063. This will give me amount at the end of second year. 60605. What is the loan life further? 2 more years. So this is to be amortized over year 3 and year 4 at the rate of half it, 302 or 303. This one. Sir, those who have understood this and you are writing this, please fill up third year, fourth year also. If you have not already copied, please copy. The question booklet I have given the answer anyway, but you keep half of answer in your notes. Sir, in this sum, what are the possible mistakes you can do up to now? Where can we mess up? Up to now. Prepaid staff means a prepayment law, you can make a mistake. Where exactly? Put a bank to staff loan mistake, nobody will do. That is too basic. PV factors, you should be careful, sir. Today means on the day when you are accounting, that is today. When I wrote first entry, I was there at the beginning of year 1, 0 time loan. But now when I am doing prepayment adjustment, I am already standing at the end of second year. So my remaining cash flows are coming across third year and fourth year, which are 1 year and 2 years away from me. That is one thing. E question anyway, there is no other discounting rate, so you will pick up only 12%. But sometimes they will give you market interest rate also, just to confuse you. Don't pick up that. If you use market interest rate, that will become fair value of the loan. ACM law, you should not do fair value. But you know, first day when you computed this 843, 886, 12% was market interest rate only. First day allowed because initial recognition is at fair value, not every year. So let's fill up the last 2 columns also. Tell me, sir, what is the closing balance of the loan now? This one. You wantedly raised it to 358,673. So on the 358,673, apply 12%. 358,673 into 12%. How much did you get? 1. Again, 43,041. Okay. 43,041. Bank to staff loan, 2,16,000. Here, of course, you will pay 2,08,000. This amount you identified as 30,302. This should become nil. What's the closing balance here? 185,714. Last year, sir, 185,714 you have surely. Into 12% if you do, some amount will come. Don't write that. 185,714 minus 2,08,000 you do. What is the net figure, ma? 22,286. Last year ka interest, it is better you take it as a balancing figure. Even if you directly work out also, nearly it should come off. How much is coming? How much is the gap? 185,714 into 12% if you do, how much are you getting actually? 285, just 1 rupee gap, huh? If 4 decimals you took, no sir, accurately only it will come. But anyway, for any purpose, take it as balancing. Guess how many marks this came? 16. 16 marks. People who read this, who did this, practice this, a 16 will come into your pocket. Maximum 20-25 minutes, so it will be solved. There are other questions also in staff loan. They are not this type, lower than this. Means only loan given, you just have to account it for all the 5 years. Nothing else you have to do. No prepayment, nothing. There is one more case where employee comes and tells the company that, company, I cannot pay money in 3rd year, 4th year, 5th year. I want extension by 1 year. Means this is a case of prepayment, no? That's a case of postponement. Sir, what should I do, sir? What will you do? Same thing you have to do. See, ultimately, if ACM has to work, the closing balance of the asset should represent the present value of future cash flows. The moment you disturb the schedule, it will not represent anymore. Therefore, disturb the amount also, no, simple. But normally, 525,610, after paying 2 lakhs, it became 325,610. Is 325,610 present value of 216 and 208? No. So what will you do? Update this also to this. Prepayment and postponement, the same thing will happen. A sum why I am not doing with you immediately is, in that sum there is a concept of impairment also. So after covering impairment loss on financial asset, I will take you through that sum. Easy only. Now also we can discuss, but after impairment we will discuss.